You've probably heard you need $1 million, maybe even $2 million, to retire comfortably. But what if I told you that number is missing a huge piece of the puzzle, one that could easily add another $500,000 to your tab? We're talking about healthcare costs in retirement, and the 2026 reality is far more expensive than most people are planning for. Fidelity estimates a couple retiring today will need $315,000 just for healthcare, excluding long-term care. But that number is growing fast, and it compounds with inflation. Many people assume Medicare covers everything, but the truth is, it leaves massive gaps. We'll break down exactly what those gaps are, the premiums, deductibles, and out-of-pocket maximums that stack up, and compare it to what retirees actually face. By the end, you'll see how someone in your situation can stress test their own retirement plan against these costs, and stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Alright, you've probably seen those fancy retirement calculators online. Punch in your age, desired income, and poof, out comes a magic number. Maybe it's $1 million, maybe two. But here's the reality. Those calculators often completely miss the biggest, most unpredictable expense for retirees: healthcare. Fidelity's latest estimate says a healthy 65-year-old couple retiring today will need an average of $315,000 just for out-of-pocket medical expenses throughout their retirement. That's not including long-term care, mind you. Think about it. We're talking about copays, deductibles, prescription drugs, and even some premiums that Medicare doesn't fully cover. This isn't just some abstract number. This is what gets subtracted from your investment portfolio or your Social Security check. And in 2024, with medical inflation hovering around 4 to 5%, outpacing general inflation, that $315,000 isn't shrinking. It's actually growing. So, if your ideal retirement savings target doesn't explicitly account for hundreds of thousands in medical costs, you could be seriously underestimating what you'll actually need. Today, we're going to break down exactly what those costs look like in 2026 and beyond, covering everything from Medicare premiums to unexpected procedures, and what that means for someone building their retirement nest egg. But what if that initial sticker price of $315,000 for a couple is already shockingly low? Fidelity's latest estimate says a healthy 65-year-old couple retiring today will need $315,000 just for healthcare costs throughout their retirement. Think about that for a second. $250,000, and then some, before you even factor in daily living expenses. This isn't some back-of-the-napkin guess, this is a projection from one of the largest financial services firms in the world, reflecting what a healthy couple retiring today can expect. For an individual, that number stands at $157,500. Now, it's crucial to understand what this $315,000 actually covers. It's for medical premiums, deductibles, copays, and out-of-pocket prescription drug expenses. But here's the kicker. This figure excludes the potentially catastrophic costs of long-term care, things like nursing homes or in-home assistance, which can easily add hundreds of thousands more. The lesson here is to differentiate between regular medical expenses and extended care. And we're not even looking at the 2026 reality yet. The 2023 inflation rate for healthcare alone was a staggering 8.1%, far outpacing the historical average of 5.4% annually. So, if a couple retiring today needs $315,000, what happens when that 8.1% compound inflation hits for another 3 years? Consider someone like Susan, who retired in 2022 with a modest nest egg. She budgeted based on pre-2023 projections, only to see her actual healthcare costs surge dramatically last year, quickly eating into her reserves. The lesson here is that relying on static numbers in a dynamic environment can be perilous. This is why just looking at the sticker price is misleading, because most people are banking on Medicare to cover the bulk of it. But what exactly are Medicare's massive blind spots? But here's the kicker. Many people think Medicare will cover everything, and that simply isn't true. It's a common misconception that Medicare is this magical, all-encompassing safety net, but Parts A, B, and D still leave you on the hook for deductibles, copayments, and coinsurance. For instance, in 2024, the PARTA deductible for a hospital stay is $1,632 per benefit period, and after 60 days, you start paying a hefty daily coinsurance. This isn't free healthcare, it's just subsidized healthcare. Beyond those cost-sharing elements, the biggest blind spots are the services original Medicare simply doesn't cover. We're talking about routine dental care, think cleanings, fillings, even a simple crown that can easily run $800 to $1,500 out of pocket without private insurance. Then there's vision care, meaning glasses, and hearing aids. For someone needing both, that's thousands of dollars annually before you even think about prescriptions or long-term care. And that last one, long-term care, is the absolute monster. It's the single biggest exclusion that can financially devastate a family, with costs averaging over $100,000 per year for a private room in a nursing home. Original Medicare does not cover this. So, while Medicare is a crucial foundation, it's not a complete solution, often necessitating supplementary coverage like a Medigap policy or a Medicare Advantage plan, which, as you can guess, come with their own additional costs. But even with these, there are hidden fees that can shrink your nest egg in ways you might not expect. But what if your income in retirement actually punishes you with higher monthly premiums? Beyond those basic deductibles and copays, there's a sneaky trap called the premium trap. In 2024, the base Medicare Part B premium started at $174.70 per month per person. But for many, especially those who plan well and have a solid nest egg, that's just the starting line. The big one here is IRMAA, the income-related monthly adjustment amount. This is where higher income earners pay significantly more for their Medicare Part B and D. For instance, if you're a single filer with an income over $103,000, or a couple earning over $206,000, you're already looking at paying an additional $69.90 to an eye-watering $419.30 per month per person for Part B. Imagine for a moment a couple with a combined income of $300,000 in retirement. They could each be paying hundreds more every month just for Part B, easily adding another $10,000 per year to their healthcare expenses. And it doesn't stop there. Medicare Part D, which covers prescription drugs, averages about $55 per month, but this too is subject to IRMAA based on your income. Plus, there's the notorious donut hole or coverage gap for Part D. Once your total drug costs reach a certain limit, $5,030 in 2024, you suddenly find yourself responsible for a much larger share of your medication costs. The lesson here is that simply having a good retirement income can trigger these hidden fees, shrinking your nest egg far faster than anticipated. So, if Medicare's coverage isn't comprehensive and its premiums can actually penalize higher earners, what about the choices you make to fill those gaps, and how expensive can those decisions get? But what if the choice between two key supplementary plans could add another $4,000 a year to your retirement budget, or leave you vulnerable to unlimited medical bills? Once you've navigated Medicare's blind spots and the IRMAA surcharges, the next major decision is choosing how to supplement it. We're talking about Medigap plans, also known as Medicare supplement plans, versus Medicare Advantage, which is Part C. This isn't just semantics, it's a difference in how you pay for almost everything else. Medigap plans are designed to fill the gaps in original Medicare. They cover a big chunk of what Medicare Parts A and B don't, like that 20% Medicare Part B coinsurance, deductibles, and copays. The trade-off? They're expensive. According to a 2023 study by the American Association for Medicare Supplement Insurance, the average monthly premium for a Medigap Plan G for a 65-year-old was around $150 to $200 per person. That's an additional $1,800 to $2,400 per year per person, and these premiums generally increase as you age. The benefit is predictable costs and the freedom to see any doctor who accepts Medicare. On the other side, you have Medicare Advantage plans. These are offered by private companies and often have lower monthly premiums, with some even offering $0 premiums. Sounds great, right? Here's the catch. Advantage plans introduce new complexities. They often come with provider networks, requiring referrals to see specialists, and generally have higher out-of-pocket maximums. For example, in 2024, the out-of-pocket maximum for some Advantage plans can be as high as $8,850 per year. So, the choice isn't just about monthly premiums, it's a choice between higher fixed costs with Medigap or the potential for much higher variable costs and more restrictions with Medicare Advantage. The lesson here is that neither option is cheap or simple. It's a strategic decision that could save, or cost, thousands of dollars annually. But even with the right supplementary plan, there's one bill that can still wipe out even the most robust retirement savings. But what if there's one massive retirement cost that even a well-known estimate from Fidelity, the $315,000 figure we talked about, completely ignores? We've talked about deductibles, IRMAA, and choosing between Medigap and Advantage plans, but there's a real killer cost that often goes unaddressed, and it's the one bill that truly crushes retirement dreams. Long-term care. This is the biggest hidden cost, because Medicare, for all its coverage, simply does not cover most long-term care needs. Think about this. If you end up needing a private room in a nursing home, you're looking at costs well over $100,000 annually, based on 2023 figures. Even assisted living, which is less intensive, averages around $54,000 per year. These numbers are only set to rise by 2026. Medicare's coverage for long-term care is extremely limited. It primarily covers short-term skilled nursing care after a qualifying hospitalization, not ongoing custodial care like help with bathing or dressing. So, if your long-term care needs don't stem from a specific acute medical event, you're largely on your own. And the risk of needing this care is higher than many realize. Data suggests roughly 70% of people turning 65 will eventually need some form of long-term care, and the average duration is about 3 years. Imagine even just 3 years of nursing home costs at $100,000 annually, that's $300,000, easily wiping out a significant chunk, or even all, of a carefully built nest egg. The lesson here is clear. Without a dedicated plan, whether that's long-term care insurance or substantial personal savings earmarked specifically for this, a few years of needing help can unravel decades of prudent financial planning. This is the massive blind spot that most people miss, and it's the single largest threat to your financial independence in retirement. The national average for a semi-private room in a nursing home is over $97,000 per year, and for a private room, it's closer to $108,000. The lesson here is that while you can try to budget for healthcare, if you aren't actively planning for the unexpected costs of long-term care, you're looking at a bill that could easily drain your nest egg, even if you saved the Fidelity suggested $315,000. This is the biggest hidden cost, often ignored, but it's the one that can truly derail a retirement that seemed financially solid. So, when we look at the entire picture, from those standard deductibles and copays, to the surprising bite of IRMAA surcharges, the critical choice between Medigap and Advantage plans, and finally, the colossal elephant in the room that is long-term care, it becomes clear that healthcare in retirement is far more complex and expensive than most initial estimates suggest. The lesson here is that understanding your income sources, planning for those IRMAA thresholds, and proactively addressing long-term care insurance or savings are not optional extras, they're essential for protecting your retirement. This isn't about just having money saved, it's about knowing where those savings are truly going to go. What's been your biggest surprise about healthcare costs as you've planned for or entered retirement? Share your experiences in the comments below. And if you want to keep unraveling the real numbers behind your money, hit that subscribe button. If you're trying to figure out how to generate that retirement income to cover these costs, then you'll want to watch my deep dive into building a diversified dividend portfolio next.